Welcome to today's Web3BuidlerTech deep dive sharing session. So Web3BuidlerTech is a DAO that aims to provide education on the latest Web3 technologies. So today we have invited IPOR Labs Chief Scientist Mauricio to give us a deep dive sharing on a DAO showcase of yield optimization. Yeah. So let's welcome. Yeah. Now you can start.
Okay, well guys, so let me start sharing my screen. Can everybody see my screen?
Yes, yes.
So I guess I'll just jump into it. So, hello, as you said, my name is Tom. I'm the chief scientist of IPOR, and I want to try to blow your guys' mind of this unreasonable effectiveness of portfolio optimization in DeFi. And the reason of this long title is because I always get blown away when I see how the data and the models, they just work so well together. And yeah, I really just want to show you how to use that as a tool for your analysis, and also showcase the tools that I built. So it's called DOPE, DeFi Optimizer. That's right, the name. Yeah, so you can get, you don't have to worry about the models. You can just jump into the analysis. So let me start by that. This is the point of the what I want to talk. This is like basically the last slide, like after the whole presentation. So I just want to like put everyone on the same page and say like that's where we are going, right? So what we're gonna do, we're gonna get a bunch of data from pools on DeFi. So these data are the dots. Can you guys see my mouse, by the way?
Yes.
You can see my mouse moving.
Yeah.
Okay. So yeah, so we're gonna get some data. In this case, will be yields from different pools, average, compound. For example, there are some of the pools we're gonna look at. From that data, we're gonna build a model. So we're gonna talk a little bit of how there are a couple of models we're gonna build really quickly and the different ways to do that. And then we're gonna plot the data versus the model. And then quickly we're gonna realize that there is something wrong. And that's a good point, right? So the model helps you filter through this, maybe a mistake, or maybe there is some risk that you didn't understand before. But through the model, through the data, you can just bash both together, and then it gives you a hint of, yeah, maybe I shouldn't include this protocol, for example, with that universe. You can think something similar if you look like traditional finance, something like bonds and equities, right? They should belong to your portfolio, but are two different universes. This particular universe of data that I just plotted here, these dots are in different chains with their own particularities. But and that's why I think it's beautiful, is that the model doesn't know about block side chains and everything, but automatically, right, through the math and the data, it just sifts through and filters out. So yeah, so you can think on this risk reward model as a way to detect outliers, right? So that's one of the tools for that, and that's what we're gonna talk about. Okay, so maybe thanks for coming, guys. If you want to leave now, I think you got the talk, right? So let's go through the details. So the first question is like, what does it even matter, right? Because if you think like you look at a bond, you know that's a bond, right? You look at an equity, you know that's an equity. But like on DeFi, that's like crazy, because there are like all these tokens coming up every other day, all these projects, all these narratives. And so like the more tools you have to like understand through all those, like that noise, is just the better. So here's an example, right? I just went to DeFi Llama and I was filtering through Ethena token, right? Maybe a year ago or so, probably less than that. Like Ethena, I think, didn't even exist. And then over time, talk with like portfolio managers and some people on DeFi, Ethena just came up. So, okay, so very quickly, you have to go through all the pools that have Ethena and do something about it, right? Do some analysis. Where do you classify on risk and returns? And how do you filter through all the narrative? So that's why I think that's so powerful, especially on DeFi, this tooling, is because it really helps you classify, right, the risk profile of the tokens, or maybe a new pool, or segregate between different pools on the same token, the same project. So yeah, so that's why I think it matters, this, especially on DeFi. So one last background just before we keep going. I just want to talk for 1 second about IPOR, because I think if you understand what we are trying to do, you understand the motivation that we have on this optimization side, right? So yeah, so we are IPOR Labs, and we are building IPOR Fusion, which is basically an on-chain portfolio optimization toolkit for asset managers. So one example is this yield optimization strategy, right? So that's already mainnet. So in a way, this strategy needs to do this decision making every block, right? So every block in this particular case, it has only 4 assets on the universe, and every block needs to decide where do I allocate, what is the risk profile, what are the returns on these particular chains. Also, one of the tools that we had to do is like, okay, on this particular strategy, we had fluid, compound, halving, and gearbox. Should we add more or less protocols there, right? Do they belong together on the risk profile? So we use this type of techniques and analysis to like, okay, these guys don't belong together. Let's maybe move to another strategy or just drop. I don't know. So yeah, so that's why we care about this particular analysis. So yeah, that might help you guys understand a little bit of what's going to happen today. So quick table of contents here. So yeah, we just went to the introduction. So I'm going to go through simple portfolio optimization. That's basically a simple model just to understand where things are coming from, and a couple of like math equations. Just buckle up for a few moments. Then we're going to build a more realistic portfolio where we call no shorting, but basically it's a portfolio where we can only lend. Otherwise, we have to add the borrowing costs, and there would be like a different set of modeling. Anyway, it would be way too complicated for this conversation. Then there is a market impact, which is super important DeFi because of liquidity and everything. So we had to deal with that. So there are a couple of like slides and a very neat video about the market impact. And then to wrap up everything, we have DOPE, which stands for DOPE Optimizer here on my background. Yeah, so that's basically a library, like a GitHub repo that you can download and do your own analysis, right? Jupyter notebooks and everything, so you can do best portfolio management, put both together. We're gonna go through a couple of examples. So yeah, so that's what's gonna happen today. So okay, let's go through a quick portfolio optimization, like 101, maybe 2 minutes. So, okay, so one way to think on portfolio optimization is to think on finding a set of weights that is gonna maximize your returns discounted of risk. And that's what this equation here is basically saying, right? So you have the returns of the portfolio, of the assets, and then you have the volatility of the assets with the covariance between the assets, like basically the risk, right? And now you weight risk return, and now you're trying to find the sets of weight, and then weights, in this case, just real quick, if you think on the strategy, right, would be how much of your portfolio. So in this example, if you squint, you see 95% on fluid, 5% on compound. So in this particular moment, the strategy that is live decided this is the optimum portfolio, right? So basically, the strategy like is solving this equation. It's way more complicated because of costs and everything, but it's like an equation that has like this, looks like this with a couple of more constraints, and then finding the set of weights, right? How do you do distribution of assets? So the last component that I want to just highlight on this particular equation is the constraints, right? So this is like the biggest complexity on this analysis is like over time, as you make it more and more realistic, you have to add more constraints. So on this one, we just have like all the portfolio needs to adapt to one, right? So we have 100% of your money needs to be somewhere. So here's a quick example of just putting like a couple of like numbers on this equation. So we can imagine like a place where we have only two assets. Let's say you have like compound and Aave pools on USDC. Only those two pools are your universe. But still you need to decide, do you put on compound and Aave? It's like 100% of one. Like what's the trade-off you want to do? So you can imagine that given these two pools, you have like different distributions. Right? So for example, you can imagine a portfolio where you have 80% on like the first asset and then 20% on the second asset, right? So on this particular example would be somewhere around here. Then you can have different pools with different distributions. So you can imagine you would have like portfolio where you have 100% of assets on this pool, but you borrow from the second pool to like adapt to 100% of the assets. One thing that I want to highlight is that, and that's a part of the model and the beauty of this, there is like a boundary that given a universe of assets, there's no way you can go beyond that boundary. So that already starts hinting on and the optimization part is like, how can I find a portfolio that lies under like the closest as possible to that boundary, and anything below is just not optimal. That would be the idea of optimization. But for now, we just want to find for any given level of volatility. So imagine that you're an investor, right? So you're the strategy live right now. You have like a preference of risk you want to take. So given like the risk that you are, let's say you are on this particular line, now you need to find the portfolio that's going to give you the best returns at that particular level of risk. Remember, there is like a threshold where you just simply cannot leave, like you cannot go above that particular threshold. So yeah, the optimization here comes from the fact that I in a way, I choose my level of risk. Now I can find what is the single best allocation of assets that are going to give me the best return at that level of risk. Right, so this is the model that we're going to spend the most time. Everything else I'm just going to flash through. I just want to give a background what's going on here. So this particular problem that I just highlighted before, it has a very simple closed form. And I'll leave it as homework or maybe a question at the end, like why does it have like a closed form solution? But the point is, it does, right? There's a solution that it has a square terms on the volatility on the returns. So that's why it has like this shape, right? It's basically a square function on the rates of return. And the other thing that is very interesting is you can already see some of these risks coming up, right? So in this particular like data, right? So I was using DAI pools on a number of different protocols, and you can already start identifying. In this particular case, was more for Aave, the pool. And that's when I had this moment that I thought was like crazy that the model can like start filtering through this risk. Because if you look at the equation, like it doesn't know what is a blockchain, right? On the previous example, the first one of the slides, it doesn't know this concept of bridge, right? It's not like this model, yeah, it never saw a blockchain, but still it can break and separate the risk and returns of the pools. So that's what blew my mind. That was the first plot I did. That I was like, why Morpho is so much better? And then I started digging into it, and there was like exposure that risk that it's just not the same as Aave and Compound, right? It's really there is like a risk, an extra risk in that particular asset. It's really similar to if you think like again, bonds and equities, right? They are assets, but they are like different universe. And the model, right? If you look back to the equation, yeah, doesn't know what is a bridge. You don't have like a term bridge liquidity or whatever, like it's a side chain or not, like there's nothing like that. And still magical, it's not really magically, that's also interesting discussion why that happens. But and then when I saw this plot, I was like, oh shoot, I can just use this as one of the tools to start realizing like how do I filter through all this noise, right? If you remember the narrative of points this year was like, it's crazy, right? Everybody talking about points, but again, this model doesn't have this notion. You don't need to enter, right? What's the expected valuation of points on TVL, whatever. It should some of the risk already appear and be able to separate. So yeah, that's why I think this model like this and a couple more we're gonna go through is just so powerful. It's like very simple and give you these like tools to like, yeah, just separate the noise from some of the returns and risks. Okay, so that was for like you can lend and can borrow, so it's a little bit it's not really realistic. So in general, there are like maybe five-ish slides. I'm gonna go quite fast just to give an overview, because in there, like actually what we are trying to do, this is the general formula, right? So you have the risk return of function you're trying to maximize. in this case minimize, but you have a risk profile of the investor, maybe it's your risk preference. And then you have like two like constraints, right? So for example, this is the equality. So you can imagine that the portfolio is going to add up to one. And these are the inequalities, right? So you're going to, for example, if you have an extra constraint that says you're never going to put more than 50% on Aave, for example, right? So that's where it would enter as a one of the constraints. And then we're going to see when we go to Python code, you don't really have to worry too much about this. Like we just handle everything on dope. So you really just like, yeah, this just happens. You just put your parameters like these numbers here, risk aversion, and then the math happens in the background. You can focus on analysis. Right, and just like FYI, this is usually called as like quadratic programming framework. So if ever you ask if you know what is quadratic programming is, now you can say yes, you do. So yeah, here's an example. Say land only, for example, that's how you frame that problem. So that's you're trying to minimize, or the portfolio adds up to one. This is particular one saying no shorts. This is one saying like, yeah, the longs, they are like at most one. Yes. So part of the trick of this like quadratic programming is really just framing the problem in a way that follows this framework, right? This language, because after that, all the solvers and everything, they're gonna do the heavy lifting for you. And this is the solution. So here is the analytic solution that we calculated. And then, but like that's not really realistic, right? Because you cannot borrow at the exactly same rate, right? It's a different rate on Aave compound. So the actual threshold that you're looking for is this one in black, right? Where you can only do lending on those pools. And then just a table, and that's where this optimization risk profiling starts to enter into play, because you can just mix and match your portfolio to different compositions, and then you just move along the axis, right? In a way, this purple or pink portfolio would be an optimal particular, because it's like and right. So if you wanna decrease, you can just there is a portfolio, right? We can find a portfolio that follow this black line that you want, but you just cannot go beyond this level at that particular risk. So yeah, so that's part of what the optimization is doing. Again, on dope, all this would be happening on the background. So really just focusing like execution ideas, trading ideas, deciding which protocol to add or not. Okay, so the last model is the market impact, and that's the more realistic, right? Because just a quick refresher or quick introduction to the ones that haven't seen that before. But interest rates on DeFi, for example, Aave is a very big, one of the biggest markets on interest rates on DeFi. So they have this interesting model where the rate on the pool is based on the utilization rate. And they have this extra step, which is there's a kink. So it's like a linear model by parts, right? It's like two steps linear. And yeah, so this is the equation. So what this equation is saying, there is a line here with this particular slope, and then there is another line here with this particular slope. The blue dots, it's actually data that I got from Chain, and the red line is the fitted line. And then the idea here that we're gonna do on the next slide is like, okay, so let's change the returns to be based on how much money we put on the pool. So I don't want to go in details here. You guys, there is a white paper on Dope Repo. We can have a look on that, or you guys can have a look on that later. I just want to highlight that I modified the equation a little bit for adding market impact, where the returns now of the asset depends on how much money we put on or how much of the capital in percentage we put on that pool, right? So it's basically dragging the returns down by the particular slope. This particular model has a couple of problems, which again, it's a homework. Happy to talk about this another moment, but yeah. So I think what's more important right now for that model is this image, right? So now we have three models in the same image. We have the no constraints, which is just impossible because we cannot borrow. We have the lending only, which makes sense if you have a very low market impact, like maybe you are like depositing like $10,000 and like billions of TVL on different pools. Maybe you would be fine using the black line. But if you are going to chains that have like lower liquidity, now you need to take care a little bit more of the market impact. So now, yeah, the colorful lines, they look more like how the shape of the boundaries look like a different like amount of money at that particular time. Right. So if you want to read more, yeah, there's a small white paper really laying down all these three examples: the no constraints, lending only, and market impact. Okay, so given all this introduction, how do we do our own analysis? Right now, I got pumped. I want to do my own portfolio optimization. Maybe I have my ideas. Maybe I want to do some looping with portfolio optimization. How can I test those ideas? Right. That's why and how that's thinking about that we built Dope. Yeah. So just gonna go some of the code and give you some hints and some like inspiration how to start if you want to play around, right? So Dope is meant to remove all this math that I just went through out of the way, so you can focus on like, okay, I have an idea, how do I get it done? So first, you really just enter a couple of lines of code and you have data, right? And it's already plotted there. So for example, one thing that you can notice from this data is like, oh, maybe it doesn't make sense to use these particular tokens, or maybe it doesn't make sense to do any analysis before January because you see the data, right? And you do that like a couple of lines of codes, you have the data. Let's go to the next step, right? There's no, you're not getting in the weeds of developing or coding when you just want to do some strategy building and thinking or modeling. Another thing is the market impact. So on the left is the one that I just showcased with the lines based on utilization rate. Turns out that's not a great model in general because those change over time depending on a particular plot, fit a line. The other reason this model is not that great in general. In any case, we build the one that looks at the data at that particular moment of the trade and do an estimation of like how much it has been the slippage at that time, right, back in the day, right? We are building to do better. I think now, given these slides, I have a video here. Here, yeah. So this is like one quick video of all these market impact models happening I think this video is like every day. So imagine that you are doing your back test and every block, every hour, every day, depending on like the fine grain of your back test, the accounting system, right, on the back testing engine on Dope needs to know, okay, what is the slippage on that protocol at that day? So Dope is doing this calculation that we are looking now on the background. So you don't really have to think about it. You're just thinking like how much money I have, which protocols I want, what is the strategy that I want to build that I think makes that I want to test, right? So all this is just on the background. Yeah, going back to, right. So you can get the data with a couple of lines, then a couple more lines, you have a slippage model, whatever you fancy. Then a couple more lines of code. So you just instantiate the strategy that you want, pass the parameters, and then you run the backtest. We're going to see in a couple of slides, like how could we build my own strategy, for example. Right. So you run, and then you have like a quick view of how was that particular run, right? So you have the returns per day, and then the cumulative. This gets more interesting once you combine multiple backtests. And now you can imagine that you have multiple strategies, maybe on different pools, maybe different like risk profiles, maybe different tokens. But now you want to combine everything and try to analyze what is the risk profile of all these strategies, right? And if you look at this plot, you are going back to the idea of optimization. You can think, and that's why Dope, and that's think on that in mind, that DOPE was built, you can think that your strategies, they become portfolios or pools that you could invest, or pools, quotation mark. So now you can optimize your own strategies, right? So imagine at some point you're going to have 3, 4, 5 strategies, but now you want to think, okay, they have different risk profiles. Well, if you have a leverage looping strategy, it's going to have a particular risk profile. But if you have just depositing, like yield optimization, it's a different risk profile. So now I have these 2 pools. How do I allocate my assets on the same risk reward? So the idea is like, okay, you do all the runs. Now, how do I optimize on my own strategies? That's one of the steps that you can do on DOPE. But the most important is, if you follow us on Twitter, you're going to understand the silly memes we post there with the analysis and some takeaway coffee bears on tweet. So, okay, we're going to go through some code now. I just want to do some takeaways, like in a way, again, this is kind of the last slides that I have to present. The rest is code. So the market tends to price the risk already. There are some inefficiencies, and the inefficiency that happens for different reasons. And yeah, but a lot of that's already priced in the rate, right? So that's why I was asking, like, why this rate happens. Yeah, there is some, it's already there by the market itself. But also, you can use the model. This is, I think, that's the most traditional use of these models, right? You can trade risk for some rewards following these models. So that's usually how they are used. But I think the biggest takeaway is you can use these risk reward models to identify unexpected risks. So in this particular way, maybe you added these pools to your analysis. Once you model, you see these discrepancies. Now gives you like a hint. Let me dive deeper here and understand, or something like, oh, they don't have as much liquidity as I was expecting. Maybe they shouldn't be on my modeling, right? They shouldn't be on my backtest. They shouldn't be on my strategy. So yeah, so use models for identifying some of the expected risks. So I just want to go to some of the codes. So for example, let's say you want to play. I built this notebook here. You can download and play immediately. You're basically going to build your own optimization profile for these yields. So yeah, so for example, you can go to DeFi Llama, get the pools that you are interested. Again, you get the data in a couple of lines of code. Then this code here is basically those equations that I did, so you don't have to worry about it. You just build your you're just building the strategy you want to build, and let DOPE do most of the heavy lifting on the background. The market impact, then you can do your back test with we have a strategy already that do this one, and the quadratic, that do all this optimization. Every decision point tries to optimize your universe of investments. And then yeah, you can choose which risk profile you want, like the risk aversion parameter, and then you just basically building that line that we saw, you're just building on your back test. And then you can see over time the weights, like where are those pools, the funds distributed over time. So yeah, this is if you want to do a simple optimization yourself. That's one notebook. You can just go on DOPE and just play around. Another one is the DOPE itself. It's just like going through all the details. So again, download data, market models with different slippages, back tests. Right, and then 2 things here. Yeah, how do I combine back tests together later to do the analysis? And if you want to do, I don't know, thousands, you can do in parallel as well. Yeah, DOPE. So the last thing, if you want to do your own strategy, so we have this folder for agents. You really just play around the agents, right? So the idea, it's really you define your own agent, and you just need to essentially create 2 classes, on start and on act, right? So on start, where your funds will start, and then when, like, every block, every hour, depending on decision point, time frame, you need to do something. And I'm just gonna go over a couple of act functions. So for example, this transaction cost, that's a very nasty one, but I'm just showing on purpose because this does some optimization. And the idea is that all that algebra that we were looking to models, you don't have to really worry about that. Like we do all this matrix multiplication and everything, every block. So we really just like thinking, oh, I have this idea of putting this couple of strategies together. How do they perform? So yeah, it could get inspired by this particular strategy. There is this other one that's a very simple, like optimization, right? It's just every block chooses which protocols has the highest yield and just put all the money there, for example. So that would be it's a very like good benchmark because it's easy to visualize and understand the like decision point by decision point. And right, so this is like that maybe another talk or something because it's way more complicated, but it's also very powerful, which is looping, right? So when you do the looping, you have to go through a set of instructions through the backtest engine and how you do that, if you have the funds. And then over time, you have to make a decision like what do you do on liquidations? On this example, we don't do anything. And then you need to do something like every decision point. But anyway, it's there as well. If you want to play around some looping, if you have, feel free to play around. And yeah, so I guess that's it. Eager to get some questions and feedbacks from you guys. But yeah, follow us on Twitter. You can just play around with us on Dope or just check the white paper.
Yeah, very cool. Okay, thank you for the sharing. Yeah, so anyone have questions? Yeah, we have the Q&A session.
Okay, may I ask one question?
Sure.
So you are using, I think, sigma and interest rate to evaluate the risk and return of each pool, right?
Right. The returns of the I use the rate of return of the pools, the historical rate of returns of the pools to evaluate.
Yeah. So because the data you use in the graph for some pool is just one dot, so I'm wondering like, which value you are using, average historically or like some moving average?
Right. So it depends. So let's say this one here. Go back to. Can I go back to? That's fine. Okay. So on this one, I got the period, and then I got the average that on that day. Sorry. Right. So I remember how many months, but let's say 6 months. So the average returns on that day, on that period. It is like the volatility of the returns on that period. You could imagine maybe use, for example, so imagine, and I think that the strategies here, right? It's like final, like it's this last value here, right? The cumulative on the period. So in a way, this plot here and this one or this one is slightly different, but it's still trying to measure between risk and return. Does it answer your question?
Yeah, sorry, your sound is a little bit broken, but I guess you use some kind of average value in a period, right?
Yes. Let me change my earphone.
Okay, so my second questions, while you are addressing your microphone, I'm interested in like how these pools relative positions change according to time, because like as you said, the data is just from a period, but the market change frequently. So in bull, in bear, there are very different return rates in each pool. So are these pools relative positions kind of stay fixed, or due to their mechanisms, or like they will change rapidly?
So that's such a good. So first, I don't know. Second, I don't know because I haven't done these plots for these pools yet, and it's such a good question. I should do that. I'll try to make a note here and do a plot. but what happens in general, right? I've done that in the past with different assets. So they flick around, right? They move around the volatility, and you could think on these particular pools, I doubt these assets would move to the left, because these ones in particular, it's liquidity, right? One of these was Binance chain, and the other one, I think ZK chain or something. So unless they address the issue of liquidity, I don't think they would go to the left, right? But if you go back to stocks, and there's some like inherent issues, or maybe like you do that through years and you pass through the 2008, 2007 crisis, right? This would be like totally different from a year before and then a year later. So yeah, if these plots over time, they would reflect the circumstances of risk and reward on that particular moment on time. But yeah, on this one, on DeFi, I haven't done that. So, but I guess they would change over time.
Okay. So do you think this is related to the blockchain mechanism or the pool design, or like the liquidity source of this pool? So which one?
I think it's everything, and that's why I think it's so beautiful. Sorry, I'm biased, but I think it's beautiful. It's because, so it's liquidity, definitely. But like, if you imagine there is an issue on the bridges between the chains, and maybe you just can't send enough money, or maybe just it's broken. Like this plot is going to identify this, like it's just going to filter through that, and it's going to identify whatever, like number of transactions cost, because all that is in a way priced in already on those rates, right? Especially if you think transaction costs, right? They definitely priced in already. So yeah, and that's why it's so beautiful. Because if you go back to the equation, it's just a couple of numbers, volatility. There is like no pricing, no bridges, no fees, and yeah, and this identifies to a certain extent, of course, with own limitations, these risks.
Okay, so one last question. In normal economics, we will say like, if you have higher risk, you need to give higher rates to keep people in. But in these results, as you mentioned, like the curve has a U-turns when the rate is low and the risk will increase. So do you think these situations is stable, or like those pools will gradually lose the liquidity?
You mean these ones here, for example, right? I think that's what you're thinking, right?
Yes.
So I think that you think, yeah, so that's such a good question. I was in doubt if I should put this as a risk or not when I was doing the plot, because it really suggests there is some issue here as well. Maybe it might be another chain that is just very difficult to access. So people that are in that chain are happy to those returns. Maybe there is some other underlying assets. Maybe the backers really believe in the project. Maybe other points, which is like the returns are just the USDC returns that I got here. Maybe there are points here that is not really highlighted. So unless there is actually reason, like the points, maybe the chain, like there's no reason, right, for people to put the money here. And I imagine that over time they would just like phase out that particular pool. But yeah. So actually, yeah, you caught me. I was like, should this be a risk as well? But anyway, yes.
Yeah, there may be some additional returns is not priced in this pool.
Yep.
Yeah. Okay, that's all from my side. Thank you.
Thank you for the questions. Any other question, comments?
Yeah, so if there's no more questions, so let's thanks Miles today's sharing. And thanks very much for everyone to joining. Yeah, let's see you next time. Yeah.